Yo, what's going on? I'm Marcus. You're at the channel The Debt Free Dad, where we're talking finances and following my family's financial freedom journey as we are going to become first generation millionaires. Before we dive in, licensed attorney, not financial advice, not legal advice, just giving y'all my opinion, chopping it up about finances and letting y'all know what's going on in the household of the Debt Free Dad. This is a first for the channel. I actually just wanted to address a question that was left in a comment on a video that I did and give a little bit of clarity on it. So, as always, if I'm going through a video talking about something, if y'all got a question or something y'all want me to expound upon, please feel free to reach out to the Debt Free Dad. Let's go ahead and pull up the comment. Okay, I'm gonna go ahead and put it up on the screen. The comment was on the video I did where I talked about my 37, 35, something. I don't know. I'll put it up here on the screen. But where I talked about a tax bill that I had from selling a rental property. So the comment says, sheesh, that hurt my feelings, but I'm glad you all had the money set aside. I know you're a high earner and I don't know your numbers, but did you live in the house for 2 years before you rented it? I feel like it should be significantly lower after the capital gains exclusion. I think the most we owed was 3K, but I'm still working on this year. So I know it will be higher, but I'm prepared. And this is from the homie over at the channel. Go check the channel out. I put the link in the description box. Financial Demics. I like that. It's financial academics, financial demics. Y'all make sure y'all go check out that channel. And maybe one day we can, do something on the collaboration tip. So let's go ahead and talk about it. Okay, so essentially, if you sell a rental property, there are two types of taxes that you're going to have to pay. Depending on how long you held the rental property for, is either going to be a long term or short term capital gains. 99.9% of the time, if it's a rental property, it's probably going to be a long term capital gains because you held that investment for over a year. The other tax that you're going to have to pay is recapture of depreciation. And so that's really the reason why the tax bill is so high. So depreciation is short is when you take the value of a property or tangible asset and you can spread out a tax deduction instead of doing all the tax deductions in the first year that you acquire that property, you can spread out the tax deduction for that property over the life of the property. So if you buy a house for $100,000, hey, you can't take all of the tax deductions on that purchase in that first year, but you can depreciate it and spread that tax deduction that you would get over the life of that property, which is like a 30-year period. So, in essence, it'll reduce your tax liability. So, you purchased a rental property, you're depreciating it over a 30-year, you're getting a depreciated tax benefit of the value of the property every year over a 30-year period. In year one, you make $10,000 of income revenue on the rental property. If you can depreciate, and I'm just going to make it easy, I don't want to throw out percentages, but if your depreciation percentage is $3,000, you can depreciate the actual income you receive minus the $3,000 that you would have depreciated. So it reduces your actual tax value. That's a benefit that you get. It allows people depreciate the cost of property or certain improvements to a rental property over the life of the property over a 30-year period. Here's how the tax part kicks in. If I've been getting taking advantage of depreciation over 10 years that I own the property, if I decide to sell the property, I actually have to pay taxes on that depreciated value of the property. And so essentially what that means is as the value of the property goes up, there's going to be a difference between the depreciated amount or the depreciated amount benefit that I was getting per year, and you got to look at that and compare it to the value that the property increased. So you're going to look at the value that the property increased, the amount of depreciation that I took over the years, and the difference I'm going to have to pay taxes on. Here's the interesting thing about the difference in the value of the property versus depreciation that I paid. That difference that I'm paying taxes on it get taxed at my normal rate. So if I'm a in an income bracket of 40% taxes, the difference between the value of the property and the depreciation benefits I took, I would actually get taxed at my 40% tax rate on that particular gain. Now, the overall gains on the sale of the property will get taxed as a capital gains tax, long-term capital gains tax. So you're talking anywhere from 0 to 15, 20, 22%. But when you're talking about the depreciation aspect, you get taxed for where your tax bracket is. That's why it's advantageous and beneficial for you to actually have your rental property in the LLC, because that's the situation where it will really come into play. I just wanted to kind of answer that question, so I hope that that kind of made sense. So, anytime you sell a rental property, you're gonna have to pay state capital gains taxes. You're going to have to pay federal capital gains taxes, and you have to pay taxes on any recapture of the depreciation benefits that you're taking advantage of in comparison to the value of the property and how much that property went up. Again, so if I took out $3,000 of depreciation. That was what the benefit was. The percentage broke down to $3,000, but the value of that property increased. They're going to look at the depreciation I took in line with the value that the property increased. And on that difference, that in between the depreciation benefits you got and the value that the property increased, you're going to have to pay taxes on that. So essentially, you get three separate tax bills: state tax bill, federal tax bill, and a tax bill on the recapture of the depreciation of the asset that you sold. I hope that kind of made sense. I just saw a question, wanted to explain it. Okay, and in the comments, there was a mention of owning a home or living in a home for a 2 year period. Essentially, how it works for the sale of a rental property. If you can prove that you resided in a home for 2 out of the 5 years prior to the sale of a rental property, you can get some benefits for purposes of primary residence that'll provide you some tax relief. Again, I probably rented this house out in 2013, so definitely haven't been in it for the past for 2 of the past 5 years prior to the sale, so that wouldn't help out. And it's also interesting because here's where you see a lot of people get slick and funky. Because trust me, people brains start turning and they think like, we could telework now. What if my wife go down there and stay periodically, or I go down there and stay periodically just to satisfy that test? I mean, it gets too crazy. They have a real certain set of things to determine. They're going to look at where your bank accounts are, your proximity to religious institutions, educational institutions. So it's a whole bunch of factors that they're going to look at to determine if you actually use a property to satisfy that 2 out of a 5 year period. Remember, those 2 years out of that 5 years that you reside in the property to get those benefits at the sale of a rental property, it don't have to be consecutive years. They can be intermittent. But that's kind of what that question was going to. But just to answer that question, no, haven't been in it for 2 out of the past 5 years. So we essentially had four tax bills to pay associated with the sale of that house. We had to pay taxes for the income on the state that we resided. We had to pay the federal income taxes, long-term capital gains taxes. We had to pay a small tax in the state where the property is located, and we had to pay tax on my personal income bracket because it wasn't under an LLC, which, again, I always say that's the smart way to do it. That's why I was able to, and happy I was able to gut it, start from scratch, and do it. Like I always say, do it the right way. So for taxes, state where I live, we pay capital gains tax. Feds, we pay long-term capital gains tax. The state where the property was located, we paid a small tax fee, and we paid taxes based on my tax bracket as it related to the recapture of the difference between the depreciation that we took during the time we rented out and in comparison to the value that the property increased. So on the difference between those two, we had to pay taxes on that as well. That's how come the bill was so high. Now, like I said in that video, we did overpay the taxes. The taxes that we paid were just an estimate. I wanted to err on the side of caution. So I expect anywhere between, a $5,000 to $7,000 kickback of those taxes. So it may be somewhere between the $32,000 to $30,000 range when it's all said and done, related to all of the tax consequences associated with the sale. But I just wanted to break down the numbers and explain it a little bit. As always, I appreciate y'all tuning in. If y'all like this video, y'all definitely gonna like this video on the screen. Hey, y'all take care, be blessed, love y'all, peace.